the rate of return on everything, sort of let me explain this title in typical, German understatement, return on everything. It's really about a paper about long-run returns on real estate compared to other asset classes. And the everything comes from the fact that we so far know very little about what is effectively, this is data from 2015 from from Savills Research, what is effectively the largest global asset class. You see that here, global real estate, the market cap is roughly around $200 trillion. It's much bigger than the equity and the debt security market, and alone is like 2 or 3 times global GDP. So real estate is the largest asset class out there. It's also, if you look at household portfolios, if you want to know what people are doing with their money, how they're investing, how they're saving, and how they're making consumption decision, it's by far, you see that here across countries, the dark blue being residential real estate is by far the largest component of household portfolios. So reaching anywhere from roughly close to 50% in the US to above 70% in Italy. So, the title here, households are really betting the house. That's the main investment that households have. And if that's not enough to convince you that we really need to think about or include real estate, residential and commercial, but mainly residential, into thinking about long-run asset returns, it's also the main residential real estate is the main collateral of the financial system. So this shows you mortgage lending relative to GDP for a sample of 17 advanced economies from 1870 to today. And you see this mega boom in mortgage lending and in real estate lending in the second half of the 20th century. Today, roughly speaking, if you want a house number, 2/3 of the balance sheet of a typical bank are invested in the real estate, in residential mortgages, up from, and that's true even for like industrial or formerly industrial lenders, like think of the Deutsche Banks, etc., who used to be financiers of industry. Today, Deutsche Bank's balance sheet, like more than half, 60%, is also linked to the real estate market. So bringing these two together, sort of housing, residential real estate is really the asset that matters most, in terms of the size of the market, in terms of household portfolios, and in terms of its role as collateral for the financial sector, and hence for financial stability, broadly speaking, but is the asset we know least about. So just give you an example. We all know that the long-run equity risk premium, i.e. the excess return that you get in the stock market relative to a risk-free asset, be it a bond or a short-term bill, is about 6% annually. This is US data, but broadly speaking, that's similar across countries. But if I ask you, so this is the equity market, but if I ask you, what is the long-run housing risk premium? What's the return you get on what is effectively the largest asset class, the asset that matters most for households and matters most for banks? And I ask you, and you look in the literature, the answer would be, we simply don't know. And this is where this paper comes in, and it's been, long. It's also, we don't know much about these housing returns, how they vary over time and across countries. And this is where this paper comes in. And what we do, and we've done over the past years, really, in this exercise of first data collection and then data analysis, is to calculate long-run returns on residential real estate. What we also bring in this paper is new, or more comprehensive and arguably more accurate long-run return data for stocks and risk-free rates relative to what is out there. And having housing and equities and the bond market in one paper allows us also for the first time to really construct economy-wide returns on wealth. And these returns on wealth are crucial. You've all heard about Thomas Piketty's book, linking returns on wealth to inequality dynamics. So we want to know how the wealth distribution, how aggregate wealth is evolving. That's important, of course, for asset managers. If we want to know how the distribution of that wealth is evolving, that's interesting for politics and society at large. We need to know how these different asset classes perform, what their returns are, and how they compare to, how the growth rate of wealth compares to the growth rate of incomes, for example. So we're going to do that too in that paper. These are the 3 main results. And I spend most of my time actually convincing you of the first result, which is that the return on housing, the return on residential real estate, the long-run return on that asset class is similar to the long-run returns in the stock market. But the return on residential real estate is less volatile than the stock market. And it's also less correlated internationally, which I guess from a fund management perspective is an interesting insight of this paper. The second result is that what we think of as safe assets turn out to be not so safe, at least if you measure the performance of government bonds and government bills ex post, if you get inflation surprises, etc. These turned out to be as volatile, if not more volatile in the long run than what we call risky assets typically. And last but not least, talking about returns on wealth, we find indeed that returns on wealth are considerably higher than the growth rate of the economy. That's not so surprising for economists, but it also means that depending on how wealth is distributed and this wealth grows at a higher rate than incomes, there will be a tendency for the wealth distribution. Let's get into the data. New data on global returns. This is the sample. So it covers 16 advanced economies. So we know emerging markets here simply because we don't have long-run data. And you see 4 asset classes: government bills, government bonds, equities, and housing. Government bills are short-term, typically less than a year, typically 3 months government securities. In the early years of the sample, these can also be deposit rates of large commercial banks. Just to tell you what's really new here is sort of the housing returns. I mentioned that before we had scattered house prices, but we didn't have total returns. So having both, talk about it in a second, having both house prices, but also the rental component, so you get a total return on housing. We have a new equity total return series, prices and dividend yields, which we break out. What's new here is that this is no longer sort of all in the commercial space, and we can break out dividends and document these data really well. And we also bring government total return and yield series to the table. Typically before, people are working with just interest rates only on government debt, but there's a price component, so we have total returns on that asset class. Long-run returns. Forget it looks complicated notation. It just tells you there's one thing here. When I say returns, it's a total return. So there's always going to be a price component. There's going to be a price change, a capital gain. Think about a stock market, the value of the index going up by 10%. And there's also going to be an income flow component. Think about this as the dividend. If your stock market goes up by 10% and there's a 5% dividend yield on that stock market, you have a total return of 15%. The question here is, how do we calculate total returns on housing? And again, it's going to be the house price change from year to year, plus the rental income you get from the house, so the apartment, the residential investment as an income stream. And how do we construct these long-run total return series for housing? Well, it's not rocket science, but you need to, what we do and what is the sort of the technique or the mechanics behind it is to start with a rental yield. Let's say for London right now, I guess the rental yield is going to be relatively low, maybe 2%, if at all, on apartments. So we have that, and we assume we have a diversified rental yield for a whole country. We go to great lengths to get to that number. And if you have that diversified rental yield, you can effectively extrapolate backwards or forwards in time, depending on when you start, using the house price index and the rental index, which is typically contained in the consumer price indices, in the CPI. Yeah? So you start with rental yield, say in London 2%. House prices last year were 3% lower or 5% higher, and that rents have changed by 2%. So you can back out rental yields over time. That has there's one big problem with that approach, which is that the rental yield you start with matters a lot. That's number one. And number two, if you do that for very, very long periods, even small mistakes can really lead to very large differences and then accumulate into larger sort of errors in the long run. So what we do is we do a second approach, or actually 2 additional approaches to corroborate these numbers. And the first is just going to the national accounts and look at all the rental income that is generated in a country in a given year. That's part of the GDP. Right? Rents go into GDP. So if we know the total rental income, and again, it's going to be net rental income, net of maintenance, net of running the apartment or the house, etc. All these things are going to be subtracted. We have the total rental income in a given year. And we also have information on what the value of all houses and apartments is in a given country. We also have a rental yield that we can back out from the GDP statistics. Yeah? So that's sort of quality check number 1. Quality check number 3 will be what you see here. This is for the US in long-run rental yield series. It's actually the long-run rental yield series we use in the paper. You will also see there are censuses of housing we use. There are statistical abstracts. For many countries, we also have sort of quasi-journalistic financial press information. So for the Netherlands, for example, you find very often newspapers saying like, okay, here's a diversified portfolio of houses in Amsterdam. The rental yield is 7%. Here's the price you can buy these houses at. So we try to corroborate as much as we can. You see that here for the US, from 1890 to 2017 or 16, the green dots, this is the series for the rental yield for the US, aggregate rental yield for the US that we use. Yeah, it's the one we have in the paper. You see these other series, these scattered dots around. These are all these checks that we did using the balance sheet approach, i.e. using national accounts data, using the sense of housing, using previous literature from Grebler et al., using different papers. Just to give you an idea, first of all, there are these things. There's a certain margin of error, obviously, but also to show you, like we just didn't take any rental yield estimation and then extrapolate it backwards. We went to great lengths to make sure that these data add up with the information we can find in the literature. Okay. So what do we find? This is the main result in terms of long-run returns. You see here for the full sample on the left-hand side, there's always going to be a dark green bar, which is the return on the risk-free asset. In this case, it's the bill return, a real bill return. And then you have these lighter green bars, which give you the excess return over the risk-free return. If you add them both together, you have the total return. Remember, this is inflation adjusted. So these are real returns on housing, equity, bonds, and bills. The message is housing and equity are roughly in the same ballpark. And don't get hung up about 50 basis points or even 100 basis points different between the two. The message in the paper is simply long-run returns on housing are comparable to those on equities. Depending on the country, in the US, things might be different than in Sweden, but overall, these long-run returns seem to be in the same ballpark. If we focus on post-1950, you see, what I just mentioned, equities seem to be ahead by a little bit, but again, that differs from country to country. This is now weighing countries equally, 16 countries. If we do this by GDP, you see again for the full sample now, I think equities are ahead by a few basis points and maybe even a little bit more post-1950. But still, these long-run returns on residential real estate remain quite substantial and comparable to equity returns in many countries. Here you get the numbers. So our sort of new benchmark estimate of the long-run equity risk premium is actually 6.89%, close to 7. Housing is for the full sample a little bit better. You see that 7.05 there. Here you also get the nominal returns, so just adding inflation back in means equity is roughly 10% annually, housing roughly 11% annually in the long run. Post-1950, the order shifts a little bit. Equity becomes a little better than housing. But again, they are not the differences are not enormous. So first of all, we can do does this make sense what we find here for housing returns? Aren't they too high? Isn't there Bob Schiller out there who says housing is a bad investment? If the house goes up, then people just make more houses. It's just there's nothing special about houses. Yes, we'll corroborate that. The argument will be, and I think that's an important point to keep in mind, people are making a big mistake comparing the stock market indices to the house price index. And that's a mistake for the reason that the rental component, the rental yield in the housing market is much more important than the dividend income in the stock market. But I'll get to that in a second. So first of all, we can compare two REITs. There's one fantastic French REIT, which is effectively, it's called La Famille Immobilière. It was a French investment trust listed on the Parisian bourse in around 1900, 1910. And what they basically did is they bought these 15, or I think it's roughly 15 apartment buildings in Paris. And there's no leverage here. They bought them. You get you get all the information. And the nice thing is this trust was listed for almost 90 years on the Parisian Stock Exchange before it was bought by AXA in the 1990s. So we can compare the returns on this, long-run French REIT, if you will, to our housing returns that we calculate using national balance sheet data and the approach I just outlined before. And here you get the results. So the return, the mean annual return, this is nominal now on La Famille Immobilière, is roughly close to 17%. The return we calculate for French housing is 15.7, so it's a little bit lower. Now you can say maybe Paris is a little bit special, so the returns are a little bit higher, fine. But definitely we're in the same ballpark, and comparing to French equities. By the way, French equities were not sort of on the bottom part of our sample, which has a lot to do with the nationalizations post-World War II, which led to sort of bad long-run performance if you really calculate it properly. But you see, like, we're in the same ballpark for the French REIT and our housing index, and French houses beat French equities by quite a big margin. Same thing we can do for the US. The REITs start in the most diversified residential REIT. The first one was issued in 1975, so we can only do this for like 40 years, but that's better than nothing. You see that here on the left chart, you see the red one is the return on an unlevered REIT, so we had to take the leverage out there to compare with the green dotted line, which is our US housing return. Again, you see the REIT is more volatile. As soon as something gets listed on a stock exchange, it becomes more volatile. But the mean returns are very similar. And here you see the same for France, the long-run comparison between. Actually, you see that even on a sort of 10-year moving average, our French housing returns and that French REIT, they co-move quite nicely. What about taxation? Corporate profits are taxed first and then distributed. So that would, mean that we're measuring sort of post-tax returns in the equity market, but pre-tax returns in the housing market. Well, there's two things to say about this. One is, well, that's the world we live in. That's if you want to, from an investor perspective, from a household perspective, that's just what you have to deal with. If you're like a purist and you want to know what's the fundamental return on business capital versus housing capital, then you want to adjust for that, of course. But once you want to do that, you also want to think about, here's the effective corporate tax rate. So especially for the second half of the 20th century, corporate tax rates are roughly around 30%. So 30% of the earnings of companies are taken away before they're distributed in the stock market. Okay, so we want to pay attention to that. On the other hand, there's this issue about leverage. So what we measure in the stock market is a return on equity, and companies are also levered. Whereas what we measure in the housing market here is a return on asset. So we're a little bit comparing apples with oranges when we have return on asset on housing and return on equity for business. So what we can do to make the two comparable is either to re-lever housing returns or to de-lever the equity returns. It turns out it's easier to de-lever the equity returns, and we use data from a paper by Graham, Lear, and Roberts, 2014. This is for the US, where you see sort of the net the development of the debt-to-asset ratio, so corporate leverage. This is for the US only. But when you sort of just eyeball the data, you'll see there's very similar levels and very similar trends. So leverage is relatively low before World War II, and then it's roughly like 30% after World War II. And long story cut short, if you balance these two effects, the corporate taxes on the one hand and the leverage effect on the other hand, they kind of almost cancel each other out. So we do this here. These are on the left hand, our baseline equity returns. Just let's only look at the US, 8.5. If we de-lever them, they are only 7. If we adjust the dividends and adjust the profits for the effect of corporate taxation, they go back up to where we originally were. But the point is the leveraging effect and the tax effect, they roughly wash out in most countries. So these baseline equity returns are not, we can take them at face value, and they're not in any way or in major way distorted. You see here, French equity is a really bad idea. Okay, returns across countries. The winner is Finland. You wouldn't have guessed, I guess. You see the equity, bond, and bill returns for the individual countries. Finland has 10% real, or close to 10% real returns for both. You also see that in some countries equities outperform, in others the housing market outperforms. We haven't explored that in greater detail. You might think about land scarcity and other things as driving these. But on average, you see here 6.6, 7.3, 7, 6.7, very, very much in the same ballpark, which is the only message. We're not like making a race here. We're just saying like they are comparable. This is the point I mentioned, Bob Shiller saying houses are not a good investment, which is, if you look at it for the US, he's absolutely right. The US real capital gain in the US housing market in the long run is less than 1% a year. Yeah? So that's not a great capital gain. But you need to add in the rental yield. And the rental yield in the US on average is 5%. So if you add up 1 and 5, you already are at a 6% real return, which is not bad. I think that's exactly what we get for the US housing market. You see a similar pattern in the other countries, so it's important to keep in mind that the real capital, the capital gain in housing is lower than in the equity market, but the rental yield tends to be higher than the dividend yield, leading in the aggregate to comparable long-run returns. Okay. See here one last statement about volatility. The green line being housing returns. This is now like smoothed over 10 years, and the black dotted being long-run equity returns. You see that the green line, the mean is the same for the two, but the green is much less volatile. And that's sort of a final puzzle that we expose in the paper. If you look at the relationship between volatility, risk, and return in the housing market, it seems to be on average, like for equal returns in the housing market, you take much less risk. And even within these housing markets, you see, like if you have some fantasy, you can sort of put a line there into the and have a risk-return relationship for the different equity markets. For the housing market, it seems to be much more difficult to do. So Sharpe ratios are much higher for housing as a result, because equal returns or similar returns for lower volatility. Just look at this right-hand chart, cross-country co-movement. Investing in equity markets, there's basically today no diversification gains left. You invest in one, you invest in all. Yeah? The cross-country correlation is 0.8. You buy the S&P, you buy the DAX, it's the same thing. Housing is not correlated internationally. Correlation factor, the correlation coefficient is 0.2. Has gone up a little bit, but not a great deal. So the money on the pavement or in housing markets, and like just casual observation, Canada's going down, I don't know, UK not doing well, Germany booming, US holding in. Housing markets internationally are not super correlated. Yeah? And that's the main thing here. In the middle, you see that if you want an inflation hedge, housing is the much better inflation hedge. Equities are terrible when inflation goes up. And you see that the correlation is actually negative. So when inflation goes up, equity returns go down. The last statement is in here. This is the R minus G, the outperformance of wealth returns over real growth in the economy. And the message is, in that sense, that Thomas is right. There's just two periods when really wealth grows less, or higher. The real growth rate of the economy is higher than the returns on wealth, and that's in the world wars, in the war periods. Otherwise, the returns on wealth are roughly 300 basis points, 3 percentage points higher than the growth rate. So indeed, wealth accumulates faster than incomes grow. Thank you.